Right. So now we're going to talk about the weeklies, structures, flies, and investments. So let's talk about what we're going to talk about. How weekly options decay. I'm going to get into kind of weekly options. We're going to talk about the different uses of weekly butterflies. I'm going to talk about broken wing weekly flies, and I'm going to talk about the weekly wheel, which is basically the wheel. All right. So if you've seen me kind of dig into the wheel, or if you caught our options for stock trader, then some of that will be a little bit repeat, but this is a ton of new material. Andrew's told me, he and I actually swap slides before we start, and we look at what the other one is presenting so that we don't overlap. And I liked what he was putting together, and he said he was pretty pleased with what I put together. So, a tale of two weeklies. All right, there are actually two forms of weeklies options. All right, there is the weekly options that list every week and expiring that following week. All right, and then there are weekly options that list 4 weeklies on a rolling basis, and most are now the latter, and very few are the former. There are some important differences in how they trade, and this is the key. All right, so the weeklies that list as 1 week, yes, it should. So the Thursday before the next week's, so these list the Thursday before the next week's expiration. All right, so a May 1st option will list on April 23rd. So the options that expire next Friday, May 1st, listed Thursday morning. All right. The weekly does not list when there is a regular option contract. So expiration is May 15th this month. And so there won't be one that lists on May 7th. All right. If they did it. All right. This used to be how all the weeklies were listed. I mean, this was for about 6 months. Every Thursday, you'd have all these, Apple, Amazon, all these crazy stocks would list a weekly option that had 9 days to expire, essentially. But now, almost none do. The only time you'll really see the weeklies listed this way is when it's a weekly option that is, a brand new weekly option. So it's a stock that didn't have weeklies, and then they just started listing them. So a name that popped in this week was IDCC. All right. So the weeklies, like above, have a herky-jerky decay that ebbs and flows through the week. All right. However, typically these only exist in, like I said, new weeklies and a few small indexes. A few slow ETFs will have them as well. However, it's important to understand how these options decay. And this is the key. All right, and this is how these contracts move. All right, what you have is when they list a new option, all right, and it's brand new, so it just exists it exists and then dies in 9 days. All right, they come in on that Thursday morning and they just slam the premium. They slam the premium as much as they reasonably can. Basically, if you think about it, when we list an option on a Thursday, of the first, so we've got a 9-day option, and in its first 4 days, 2 of those days are the weekend. All right, and if we've got a long weekend coming up, it could be as much as 3 of those days. So there's a race in traders to try and pull out the weekend as fast as possible. How do holidays affect weeklies? Do they still expire even though the market is closed? No. Weeklies expire on Thursday night, when there's a holiday. So like when the market was closed for Good Friday, everything expires on that Thursday. All right. So yeah, I mean, you can have just crazy days. So you can have but think about this: in the first 4 days of this option's life, 2 of those days, at a minimum, are when the market is closed. So you have this race to get premium out. All right, and usually by Thursday afternoon, that premium decay slows down to a kind of a normal progression. So you'll see like a huge portion come out Thursday morning. Then it'll kind of stop for the day. Sometimes it can get oversold, and you'll actually see these options increase in volatility. Then Friday morning, they start torching again. And I found this over and over and over again. There is such a penchant for premium sellers to try and kill the weekend that one can get a free look at a weekend sometimes. Now, what I mean by that? Well, they come in and they sell options so cheap that they take too much of the weekend decay out. All right? A weekend by Friday night, a weekend should have enough decay in it that it mimics an option being, the amount of decay an option goes through from market close to market open in a normal day. So all right, we're okay. I just want to make sure. I don't want I want to make sure everyone can hear me. Yeah, okay. Sorry about that. So what you'll see is that you get this ebb and flow where they come in and they take the option down so much. All right, so let's just pull up, we can just do IDCC. All right, so if we look at this straddle, now they've got earnings next week, so that's why the volatility is crazy. But what they have a tendency to do, when the market closes on a Wednesday, all right, so let's say at the close, let's say today was Wednesday, all right, and the market closed. This 54 call should be worth a little bit less when the market opens on Thursday. All right, there's some theta decay that comes out. All right, so if it's losing 19 cents a day, typically you'll see at least 2/3 of this theta come out during the day, but not all of it. So what a weekend should kind of act like, and the amount of decay that should take place over a weekend is kind of like a wake-up. So the market closes on Friday and opens on Monday. Options should have a little bit of decay in there. All right, now they price out a bulk of it going into the weekend, but there still is some. And so what will happen is you get traders that are so aggressively selling premium that they sell out some of that wake-up premium. All right, so you get a scenario where we could theoretically close on a Friday, open on a Monday, and the option loses, a penny or two instead of, somewhere between a nickel and a dime. In this case, probably, 15 cents. So if I can buy an option and then overnight, so if I can buy an option at the end of the day and the next day when the market opens, it has a break even, or with the underlying in the same spot, if that option is break even or a little bit worse than break even, that option was probably too cheap the night before. Right? If you look, has anybody been paying attention to how the market has been behaving in the overnight sessions? How futures have been moving around? Almost all of the movement in the market over the last couple of weeks has taken place overnight, and we just gap open. And then nothing happens. I mean, it's been a larger percentage, and certainly in the VIX futures. The other piece we've seen is overnight we get this gap down, and then we rally it back through the day. It's been, overnight, there's been a lot of gaps. The trader's asking why. I don't exactly know why. I really don't. But that's the way the market's been behaving. Probably because the risk is more in Europe than in the U.S. Earnings have been good. But, so there is a significant, my point is there's significant value in the overnight portion of an option. And so if that gets oversold, you want to buy it. So with these weeklies that list, so there's tons of people that look to sell these new weeklies on a Thursday morning. There's not as many people looking to see if they get oversold on Friday afternoon. And there can be some edge. All right, and then typically, once we get to Monday, the weekly starts acting like a normal contract in expiration week. All right? Now, this was a really fun way to trade for a while. All right? All right? So, but this is really what happened. All right? Weekly options were so successful at onset. All right? But the crazy decay and herky-jerky nature of the options caused people upstairs to actually think for once. And they said to themselves, as these are popular, but we're getting all these complaints about how they decay and how they move and about liquidity. So what they started to do was listing 4 weeklies around the standard front month expiration. All right? So these options behave almost normally in terms of decay. There is no secret selling sauce, all right, like there are in some, or secret buying sauce, like there are in, those brand new weeklies. Now, that doesn't say that normal market trends don't exist. There are still times where options get oversold on Friday afternoon, and I can get a cheap look at a weekend. There are still times where these options are overpriced and I want to sell them. But the decay, the decay is the key. All right. These options behave, they decay like a normal contract. All right. And if I have an audio problem where you guys can't hear me for a section, let me know and I'll repeat myself. All right. So the main advantage of the weekly options in respect is pinpointing events like earnings or dividends for option plays. And as Andrew covered, calendars. All right. The greatest thing about weeklies, in my opinion, is the ability to set up calendar spreads however you want. All right. You can decide what you want to own. I mean, look at this. Anybody know what stock this is? If you can guess what stock it is, I'll send you a free copy of my next book when it comes out. First person. And no cheating. Well, Dave, you win. It is Apple. All right, it is Apple. So we've got this, you've got this scenario where I can actually see, all right, earnings are next week, and I can kind of trade around it. All right, so and I think Andrew covered calendars in detail. Just wait till we do an entire class on calendar spreading. Now, sadly, those that think there's some secret sauce missed the 2-month period where there was a secret sauce on weeklies. However, you, and you guys in particular, are armed with the understanding of decay, where decay speeds up and where decay slows down. You guys remember that whole discussion on decay that I went through in the free weekly class? All right, so the way to think about it is the further away we move from at the money, the more decay becomes linear. There is a recording. It is on the page that you used to sign up for this course. So the further away we go from at the money, the more decay becomes linear. All right, especially in the final week. All right, and the cone of viability, I always called it the cone of feasibility. Andrew edited these, but so have you guys ever heard me talk about the cone of feasibility? All right, so let's talk about the cone of feasibility here. So let somebody pick a stock. I don't care what stock. And not Apple. I'm sorry. And not Tesla. I won't do any fanboy stocks. Bank of America. GoPro. You guys just threw out every single fanboy stock in history. All right, Starbucks is perfect. Okay, Starbucks. And I know you guys are doing that to taunt me. All right, so let's talk about Starbucks. All right, Starbucks is trading $51.84. All right, so next week, do you guys think that, yes, 1999, funny. Do you guys think Starbucks could get to $56 by next Friday? No. What about 55? 54? All right, 54. 53? What's a level that you think? All right, so at 53 bucks for sure, you think Starbucks, that's a level Starbucks could get to by next week. And if you look, really right at the way the market is pricing premium, at 53 bucks where everybody said, hey, all right, you're going to see that's the first option that has a nominal value over 10 cents. All right, it's going to lose on Monday morning. You guys aren't going to feel strong about the 53s, and they're going to fall outside of the cone if Starbucks doesn't move. All right, now the 52.5s for sure, right? And the 52s for sure. Those are in play, right? So these are the ones that are going to see that swift decay. All right, you're going to see a little decay on Monday out of the 53s. Then they'll slow down just like the 53.5s and the 54s. So as options go from that is a real possibility to that is unlikely to happen, that is when they decay at their fastest. Does that make sense? All right. And so I call that the cone of feasibility. And the reason why it's a cone is the further out in time we go, the wider the cone gets, right? So what about in June? Could Starbucks get to $55 in June? You're darn right. It could get to 57.5. You know, 57.5 is right outside the cone. June is inside the cone. All right, so that is how this whole thing works. So what you want to do is you want to buy options in the week that are just outside of that cone of feasibility. All right? And you want to sell stuff that's inside the cone of feasibility. All right? Now, at the money options, they stay in that cone. Do I have a picture of this cone? I could draw it. I've definitely drawn it before. Why don't you think about it this way? There we go. I don't use Thinkorswim very much. I'm sure it could. Their probability calculator is kind of like that cone of feasibility. You know, it kind of looks like this. So that's kind of what I think. And the truth of the matter is that, you know, it's kind of based on probabilities and on implied volatility, but then, you know, it's pretty simple to see just in price. All right. So we just did that kind of thought experience, like with IBM. You know, could it get to 200? You know, so like the one I like to use is, all right, IBM's trading 170. Could it get to 200 next month? No. Could it get to 200 by July? No. Could it get to 200 by October? Probably not. Could it get to 200 by January? Yes. All right. So October is what? 6 months away. January is 9 months away. All right. So the 200 call is going to lose a lot of money between now and June. As it becomes unlikely to happen. I'm not showing IBM. Just talking about it. I like to buy, you know, I typically like to buy something worth a penny, 10 cents. You know, that's about the level I like to buy. We're going to talk about this. All right, so just remember that, you know, in the weeklies, wing decay is basically linear, and at the money is explosive. Now, there's one other piece to this, and I know I've talked about this, right? It's the gambler's price that gets permanently priced into an option, right? Market makers don't like to sell options that are, even if an option is completely worthless, market makers do not like selling options that are worth a penny or 2 cents or 3 cents. So that makes those wings even better, right? So I sell this at the money that just has this, just throws up decay. And then I buy this wing that has linear decay until it gets to be worth about 3 or 4 cents. And then decay slows even more. You know, you could probably say right at kind of the, in the weekly option, it's going to be right around the 10 or 15 delta. All right, so if I look at SPY, right, it closed 211.65, and or let's go to May. All right, so next week's option. Does anybody think SPY is going to go to 185 by next Friday? Yeah, you do. Nobody does. All right. Does anybody think SPY is going to go to 218 by Friday? So a 70-point rally or a 30-point sell-off? No. Yet all of these options have a penny bid. And the downside of the curve is even worse. I mean, there are people that will pay a penny for the 185 puts all the way to 198. So those little cheapy out of the money puts, they will keep a small piece of their value for an extremely long time. I mean, let's take a look at last week. I mean, so this is Thursday. All right, so here's Friday. And this is SPY. So take a look at this. So Thursday night, there's a penny bid with SPY at 211. A full 100 points out of the money. Someone's willing to pay a penny for those puts. A $10 move in SPY. All right. So if you are a person, I mean, look at this. These things will decay forever. They take forever. So we've now got this setup where I've got this exploding decay at the money. I've got wings that are linear, and then get to a certain point, it basically stopped decaying. So most of the people here are reasonably intelligent. All right, most. What should you buy and what should you sell? All right. I mean, the answer is butterflies are the best way to harvest premium out of weeklies without taking a directional opinion, without taking a volatility opinion. All right. And the crazy thing, because of that the way these two options decay, the way the pieces decay, how short a period of time one needs to be in a butterfly to make money. All right? And the reason why people don't make money trading butterflies in weeklies is because they're greedy. I'm telling you, I would say 80% of the people that I see fail are Sammy Sosa's. You guys know who Sammy Sosa is? He was good at two things: hitting home runs and striking out. And obviously putting steroids in his body. And, you know, the thing to remember is that, you know, that's the way a lot of people think. They want to, you know, the reason why he struck out all the time is because he was constantly trying to hit home runs. All right? So if you if you play like Tony Gwynn, you'll get to the Hall of Fame. All right? Singles that sometimes turn into doubles or home runs. Pigs get slaughtered. Smart little piggies go to the market and buy roast beef. Just remember that. And then they go wee, 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 wee all the way home. So this is an example of a butterfly that one could have done in Apple. All right, on Monday, you execute the 120 at the close. You execute the 125, 127, 128, 130 butterfly. The next day, so net, you're paying 61 cents for the wings, and you're collecting $1.84 on the thorax. Yes, I wanted to show April 24. So these expired yesterday. So what I was buying, what I would have bought in this thing, I didn't do this trade. Plain and simple, all right? But it just was so easy. So if on Monday, at the end of the day, last Monday, you bought the 125, 130 strangle and sold the 128, 127 strangle, I think Apple is around 127.5, something like that. So if you did a broken wing butterfly, a split strike butterfly, basically selling the 125, 127 put spread, selling the 128, 130 call spread, you would have paid 61 cents for the wings and collected $1.84 on the thorax. That's $1.23 in credit. So what's the margin on a 2-point vertical where I collect $1.23? What's the margin I put up on a one lot? $77. All right. I spent more than that at Costco yesterday, buying dog food and tamales and turkey, ground turkey. So the next day at the close, Apple's down a little bit. Take a look. My wings lost 16 cents. The thorax lost 34. So my $1.23 trade is now worth $1.05. That's $18 on 77 bucks. Oh, I like that. Golf metaphor. Chip your way to the green. You'll never shank a drive. Yeah, but you'll still hit like 5,000. So the margin on a weekly fly was 77 bucks contract. So a 10 lot would be 770 bucks. In one trade, the trade makes 18 bucks. That's $180 over $1.70 on a 10 lot. 23% in a day. If you did that every day, you'd make 45 grand on $770 of risk. You know what 40, that's not bad. All right, that's not bad. I could 45 grand. I could afford to buy my wife like 2 pairs of shoes and maybe a handbag. All right. Well, Ruts and Index. We're going to talk about how to decide when to do this. What about earnings? Right. Don't commissions kill the trade? If you have commissions that are high enough that they're killing the trade, you are losing. You are paying too much. You know, on 18 bucks, the 4-lot, the 4-lot in and out should cost you, in total, let me see, the most that should cost you is, like 48 bucks. If that costs you more than $48, then you are paying too much. All right, and that's on a 10-lot. All right, so, obviously, does anybody think that it's that easy to make 45 grand? Or 35 grand, all right? No, but guys that are good at figuring out where vol risk is and where things are going to do well. So it's not easy because not every trade works that well. Not every trade wins. But it is not that difficult to figure out that a stock won't move for a day. All right? Now, don't do the same stock every week. Don't do, have a grouping of stocks that you really get to understand. And then do this in your top 1 or 2 candidates. But the thing to remember is there is a vol risk premium that is overpriced. There is edge in this trade most of the time. All right? So I think weekly butterflies are a lot like punching a person much bigger than you. All right? You punch them once when they don't see it coming, and then you run like hell. All right? Pick your spots, get out. And let's go back to this butterfly so I can make my point on it. So you make 18 bucks in the first day. All right? 2 days later, all right, so 2 days later, this is Thursday. That fly is now worth $1.40. Great work. Great work, guys. Way to be greedy and kill the trade. This is why most retail traders lose. They think they need to make a lot on every trade on these trades, when really what they should be trying to make is about 20 bucks a fly. Or something like 15% on risk. All right, and if your commissions are too high to do that, you need to fix your commissions. Indexes, yeah, you absolutely can do these in indexes. The issue is your indexes. So the one thing to think about is that I think it's easier to find stocks that aren't going to move than to figure out whether an index is going to move. Indexes move much more in a macro sense. I mean, I just think there are better trades in things like SPX than a weekly at-the-money butterfly. I like, in something like SPX, a broken wing butterfly might be the way to do this. What's the best way to execute? Do the wings and then sell the thorax. I usually do them either as put spreads or put spreads and call spreads, or I'll parse it out in 4 different pieces. That's typically the way I do. Now, one of the nice things is if you're using something like Interactive Brokers that actually passes through payment for order flow, you may be able to actually get your commissions to the point where you're actually not paying commission on this. What is the most optimum number of hold days? Yeah, if you're in a trade for 2 days in a weekly and you haven't made money, close it. And I'm going to talk about that. All right. So when picking a butterfly in the weeklies, the key is to think about the next 2 days. That is it. All right. What is going to happen? So it's Monday morning. What is going to happen between now and Wednesday morning? That is all I care about. All right. I don't care what you look at. This is where having multiple things that you look at. You know, I personally look at volatility, you know, realized and implied. But maybe you look at candlesticks and Bollinger Bands or news. You know, I think weekly butterflies are better for stocks than they are for indexes. Yes. Can I cover risk assessment? So what do you mean? So scanning. All right, and I'll come, you know, if you give me a little more clarity on the question, I'll cover. So risk relative to margin. Oh, I want you to make about 15%. All right. Are the ETFs, you know, the one ETF that's pretty good for weeklies is EEM. For some reason, the volatility premium in EEM is just disgustingly high all the time. And it's so many countries that it really doesn't move as much as people think. So yeah, all you're trying to do is make 15%, and that's before commissions. EEM. Yeah, Echo Mike. Yeah, that one is super overpriced. So here's some things that I look for. I look for stocks with imploding implied volatilities. All right, so that means they're crushing the implied volatility at the 30-day strike. Now, why do I look for that? So the first thing I do is look for equities where they're crushing the volatility. And if it's after earnings, it makes things a little more opaque. All right, but what I want them to be doing is crushing the volatility, and the volatility not to be disgustingly cheap. Because that means there's still room for it to kind of come in. All right, so I'll also look at historical vol. So like, let's look at, you know, General Motors. You know, they just had earnings. And you can see, you know, this is about as cheap as the vol has been. Now, the VIX is low, about as low as it's been in the last 2 years. So that needs to be taken into consideration, right? But like one name that I think is great and has real potential to be a pretty good sale for the next few weeks. USO. The realized volatility is sinking. The implied volatility is sinking. But the implied volatility can go all the way down to 16. All right, now here's like Ford. They've got earnings, so unfortunately that throws them out. Facebook is at an all-time low, right? This is a 2-year low, so I don't want to touch it. Unfortunately, we've got earnings going on right now, which makes things a little tricky. ExxonMobil has earnings coming up. Maybe who's released last week that might be a good one? McDonald's. And actually, what's interesting is the vol's going up, and they had earnings. This might be one that could be an interesting little one-day risk premium trade. I mean, the stock's moving around some. That might be one that I look at on Monday morning and say, all right, is it going to move between now and Tuesday night? All right, so do we all kind of get what kind of stock I'm looking for to do these this little butterfly trade? All right, so look for imploding, but still somewhat high, not super high. What will I look for Monday? If McDonald's is moving around on Monday, I'm not touching it. And I actually want to see so the volatility start to come in Monday. So I want to see volatility get sold Monday, and then I will. So when the smart money says this is overpriced, I'm going to join them. As smart as I am not smart money. Exactly. But that's one that it's going to be on my radar now. All right, so look for imploding realized vol, a severe drop in movement over a 3 to 5 day period, where the stock has stopped moving, but the vols are still high. Like USO looks really good for this. Skew. All right, skew. All right, so the price of puts and calls relative to the straddle. You want it to be flat. You don't want to pay too much for puts. All right, and one thing to look at is that theta. How much do you collect in theta? All right, so if I pull up Apple, all right, let's do Facebook. Yeah. I want to find one that I actually want to do. We'll look at USO. All right. So if I pull up USO, see it's trading 1967. I mean, this is a relatively tight fly. Jeez, super tight. All right, so I've got on a 10 lot, see the 27th is, all right, so on the 20, if I did this, it should be worth about the same on the 27th. So what I'm really looking at is what is my P&L on the 28th? And I make 58 bucks on $230 of risk. All right, that's 25%. Now on that 58 bucks, on my 10 lot, right? So it's 4 times 10. 40 contracts, and this is where you do have to think about this stuff. If I'm paying, let's say, 50 cents a contract, I'm losing $20. So it now becomes 38 bucks. But 38 over 230, 17%. How about using low beta stocks in general for this trade? I think that makes a lot of sense. I'll bet low beta stocks typically have more overpriced implied volatilities than high beta stocks. All right? Look for imploding realized vol, a severe drop. Prior movement should be normal, not crazy, which is the problem with McDonald's. And again, 2 days. That's it. All right. The fun thing about weekly flies is there is really no management. Do not try and adjust weeklies by adding or some rolling technique that adds margin. I have seen people turn a butterfly with 3 grand of margin into a $10,000 loser. There is a teacher out there that likes to show people, oh, just keep adding flies. There's a quick way to blow out. Clearly, they never had managed the risk of a book. All right, now, if you want to be a manager and you want to manage one of these trades, go ahead. All right, I would encourage you not to, but go ahead. And I'll show you how we could have done it in that apple fly last week. All right, so I'm going to do this, then we're going to take a little break. So I'm at slide 21, and I've got 47. Holy bananas. I promise you get a lot out of this, didn't I? I think the back half will be a little faster. We're going through a lot of content. So we're going to take a mini water break here after I do this. Let me get option view up. Not a big fan of option view, but it's kind of like all right. So let's go to Apple. It's garbage. It's slow. It's like it's kind of like how the bear, it just I don't need it. All right, so I'm just downloading these files. This will take a minute. So tell you what, while this is downloading, why don't we take a 5-minute break? Remind me to put the recording back on. So we'll have to use TD. This will be a little more clunky. All right, so yeah, next I'm going to teach you how to use these for direction. Well, the basic management tool is to take buyback at the money, buy back the short calls and puts as the underlying moves around, and you end up kind of getting a ratio spread out of it and taking risk off the table. And so what I was going to kind of show you is how I actually could make money on that butterfly by slowly buying back calls as Apple rallied through the day. Okay, you can see how often I use TD. I mean, they're fine, but they're expensive, and their analytics for using VIX are worthless. That's my issue. If anybody here a VIX trader will understand my frustrations with TD, Ameritrade. Plus, they're expensive. Scans using Stock Hacker. All right, so let's go to Think Back, and we'll just look at Apple. All right, so let's go back to the beginning of the week. All right, and we'll do, all right, so here's the beginning of the week, and we'll put on our trade that we talked about. Oop. Never mind. Let's do this. All right. So we go to the next day. Trades up nicely. It's still kind of just sitting there. Really nothing to do. Right? I don't have much of a, I've got a little itty bitty long delta. All right. So if I wanted to, I could cover my delta by buying one put. But that's a little overkill. Now the next day, Apple has a nice rally. And you can see I now, let me get the P&L up. All right. I'm still up money, but now I've got a pretty big short delta. So what am I going to do? I've got a short delta of 150. I buy 2 calls. All right. Now my delta is still short, but not too short. But I've reduced my theta, you can see. Next day, we're up a lot more. But you can see I've kind of done well enough on this. If I want to stick to it, you can see I've got a short delta of 200 again. Now, the reason why I wanted to use option view is because it would have let me update this much more dynamically. So you're not getting a real clear picture of how. So now I'm short 400, 26, and I'm long here. So my delta's flat again. So you can see I managed to basically mitigate most of my loss. I lost $300. Now, why did I really lose, though, is the question. Do something like that. That would. What did I really lose? 1, I didn't cover. 2, I can't show that I'm buying kind of throughout the day. That's the problem. It is end of day. Yeah. So, can I make it clear to you guys? Don't try and do some mumbo jumbo adjusting. All right? Don't think you're great. Get in, treat these butterflies like they're a bully. Punch them right between the legs and then run. I try to be funny. All right. So now let's talk about directional butterflies. All right. Recall the rate of decay that we talked about with out of the monies. And then talk about those insurance values. You like that better than the monkey joke? I thought the monkey joke was funny. All right. So think about this. If I will have a directional opinion over a week, all right, does it, if I've got really 2 options. 1, I go out kind of, I buy an out of the money option that is, I can buy an at the money option with a long duration. All right. When I buy at the money options, I buy 60 to 90 days usually. All right. But what I end up doing most of the time is directional flies and broken wing flies. Anybody who's an option pit live person knows how much I like broken wing butterflies. All right. So Think about this, though. We've got these options that really aren't that far out of the money that really have a super slow decay. And then we've got options that are even farther out of the money that still have value even though they're basically worthless. All right, so in weeklies, if I buy the stuff that decays slowly, then sell the stuff that is worthless but still has value, and then I buy some BS out of the money worthless option, it makes for the cheapest, slowest decaying trade that I can do over a week. All right? And this is especially butterflies. If you are a candlestick trader or a day trader or a technical trader, and you're not using butterflies, you are giving away money. These things are just the bomb for these types of things. So let's take a look at my Apple Weekly. So if I buy that first call that was out of the cone of feasibility, all right, so if I buy the 30, 31, 32 fly, at the end of the day on Monday, I'm paying 7 cents. And it's only $2 out of the money. I got 4 days to look at it. Day one, on Thursday, it's worth 17, and it expires on Friday for 25 cents. And at no point in time during this week is it actually worth less. Yeah, this is Monday night. All right? At no point in time, even when Apple is down on Tuesday, the beautiful thing is when Apple's down on Tuesday, my fly was actually worth 11 cents. All right, these little flies, for a 7-cent butterfly, can return a lot. If I pay 7 cents for a fly, I'm going to pay, what? Then I'm going to pay 5 cents in, the real cost is 12 in and out. And really, and the cheapest that I see these things during the week is 11. I saw them was on Tuesday. It was worth 11 cents. Tuesday night. On Thursday, it's worth 17. So you've made a nickel, and you've doubled your money out by Friday. And in fact, during the day Friday and during the day Thursday, you had opportunities to make a lot more than that. I mean, take a look at a chart of Apple. Let me get Live Ball back open. Are most of you guys TD people, or most of you guys Live Ball? I did. Yeah. So if we let me look at the tick chart. Yeah, I mean, there was a period of time on Friday morning where you would have been getting 60, 70 cents out of that fly. Wow. All right, so buy an option in the direction you want the underlying to move. should be worth less than 25 cents on a normally priced stock. You know, under 130 bucks, below a 30 vol. All right. Sell an option worth at least 9 cents against it. Go as far as you can from the purchase price. Buy an option at equal length or closer, worth less than 4 cents. Try and pay less than a dime on the total package. Am I entering these orders as a fly? You can. I usually would just buy the call, then sell I usually would buy the upside call, buy the downside put, then kind of sell the thorax, and then buy the kind of out of the money trade. I usually do them split up. All right, directional phi can be a broken wing with the upside closer or of equal. That's fine. I'm looking to make a minimum of 7 cents, right? Because my cost to get in is going to be, you know, if I'm paying 50 cents a contract, you know, my cost to get in on a 10 lot $40, right? 4 cents. So I want my net cost to be around 10 or 11. Certain losers, all right? All right. The idea is if you get a one where it really runs away from you, so if you're just wrong and the option quickly just goes to being worthless, it's typically not even worth unwinding. Save the commission. All right? But if you're in it for a day or two and you're at a wash, close it and eat the commission. All right? All right? On the winners, you know, if you make 7 cents on the winners and you lose a dime or 9 cents or 8 cents on the winners, you will make money. And you take out the wash sales. You'll make money. If you're a good directional trader. Obviously, that's the piece that matters. All right. Now, do we all know what a ratio front spread is? Sometimes called the 1/2. You know what do I use to set up limit orders? You know what I'll start to do is I'll ladder out. I ladder out of everything. A ratio front spread is when is buying one and selling two. All right, so in Apple, you know, a trade I might have done would have been to buy the 135s 100 times and sell 200 of the 140s. And I try and take in a credit. And then I manage the delta. That was kind of my favorite. That's kind of the market maker's favorite trade. So I buy an option that is out of the money, right at the edge of the cone of feasibility, and I sell something further out. Now the broken wing is for margin. All right. So a couple of trades, and all right. Well, we'll get to broken wings in a second. So an iteration of a broken wing fly is a 1/3/2. And here's like a bearish trade in Amazon that I might set up. All right, where Amazon's expensive and high vol, so I'm actually buying, instead of a 25-cent option, I'm buying a $2.50 option. And this is for next week. I don't like Amazon. I think they got to come back. I think they got a gap to close. They got more gaps to close than the gap. Yeah, there's nothing. I don't know why the volume's coming in and out. That's odd. I'm talking into the laptop. So the way this trade works is I buy one, you know, in this case 3 of the 435 puts. You know, I pay $275. I then sell 9 of the 425s and buy 6 of the 415s. Net, I pay a small debit. My total debit's $1.62. This is kind of what it looks like. And what's cool is it actually has a theta for a couple of days. So you look at the theta. Now on a 2% rally, the theta goes away. So above 450, I don't have theta. But you can see that I do have theta right here. So I'm actually making money for a couple of days. And then if underlying starts to move, I can do very, very well. Now, what's the issue? Well, if I'm too right, I can lose a lot of money. These, for those of you that are asking about indexes and directional opinions, I'll look. No, that's total deltas. So I am buying negative 32 deltas and negative 79, and selling selling a positive 106 deltas. My net delta is 5. Now I think I'm good enough. I could probably get this done for free. But the one issue I have is if I'm too right, I'm going to lose. All right. So when you say manage, when you say your deltas, where would you want your delta to be? How would you adjust for the downside? The way you adjust for the downside is if it really does start to move, you are covering you start covering some of the 425s, or you buy some of the 435s. All right, but really what you're hoping for is a slow move lower. This is a little longer play, and this is a great play in indexes. We had somebody asking about Russell 2000 and SPX. This is a great trade for those. Ones where they do really kind of move. All right, so if you've got a directional opinion in an index, especially bullish. So if I think S&P 500 is going up and volatility is somewhat high in the week, a 1x3x2 can be an awesome spread. Things like non-farm payrolls, these guys can be great. So the trade is similar to a broken wing butterfly, which I'm going to cover. I don't know how these flags got flipped. All right. It is a much bigger play on realized volatility than it is on an implied vol than kind of the standard fly. And you got to manage it so that it doesn't overshoot. That's why, Amazon, if you think it's going to take a quick move lower, the 1x3x2 is not the perfect trade. Well, that's the beautiful thing. So I'm going to talk about ratios. All right. So this is the trade that I love. I have a big amount of love. I love this spread. All right. And it's a broken wing butterfly. So here's Facebook. All right. This is one I could have done earlier in the week, right after earnings. So I think, Facebook's down, and I don't like it. I think it's going to rally. What if I buy the 83s, sell the 83.5s, and buy the 85s? 1x2x1. I get a credit of 2 cents, and as long as Facebook doesn't rally above 84.02, I'm a winner. And this is my favorite spread into things like non-farm payrolls. All right, we've got guys that love the 1x3x2. We've got guys that love the broken wing fly for a credit. I happen to love the broken wing fly for a credit. If the broken wing fly for a credit walked in and said, "Mark, will you marry me?" I would be divorcing my wife and marrying the broken wing butterfly for a credit. That's not true. I'd have to move. Maybe I'd try and get like a sister wives thing with my wife and the broken wing butterfly for a credit. How would that work? We would. So I do these trades a lot. So like a name like FXE, we've done these. I think we have one in the strategy letter right now, or we just took one off. Now here's the beautiful thing about these. So if I'm wrong, all right, so I think FXE is going to rally a little bit more. If I'm wrong, I make money. If I'm right, I make money. I lose only if I'm really, really right. And I can manage that delta, again, by covering some of these shorts. All right, so I love these because if I'm wrong, I keep the credit, and if I'm mostly right, I make money. And the beautiful thing with these weeklies is that because of the way they decay, that credit's gonna, if it starts moving toward the end of the week, I'm gonna make a ton of dough. Now these ones, I will typically close. I'll take them into Friday morning or Friday afternoon because I've got premium in my pocket, and if the underlying is moving in my direction, I will let that thing go. I mean, I've closed broken wing flies at like 245. All right, so now, any questions on butterflies? All right, I'm going to transition into the wheel. Going once, going twice. All right, the triple income wheel, the tandem best way to use calls and puts. All right, it's, I think the most effective way of, I like this in place of owning long stocks. All right, source one, puts. All right, sell puts, start selling puts. All right, if you've seen my secrets to the covered call and puts, then you know what you want. You want to sell puts in low vol stocks. Keep selling puts over and over and over again. Build up yield. All right, sell puts at lower and lower and lower strikes as the stock kind of creeps lower. Then take delivery, hopefully near the bottom. Source two, the dividend. All right, get the dividend. All right, get that income. If you're young, in your 30s, 40s, 20s, put it on a drip, acquire more shares. If you're older, or you actually work for the company, take the dividend into collect the dividend. Never. If you work for a company, you're trading options and stock in the company you work for, you're probably making a mistake. And then finally, sell calls. So you sell calls, all right, over and over and over again. All right. Higher and higher strike, and do it over and over and over again. Now, all right, once a full rotation of the wheel happens, wait a day or two before selling puts again. Examine to see if there are better sales. All right, like a long position, if the trader owns a stock, she still needs a max loss. All right? If an assumption changes, stop trading the wheel. So this is one that I did for the street in Oracle. And this was in last year. Sell the 39 put. Then I sell the October 3 call. I sell the 39 put, stock got put to me. I sell the 39 call 13, the 39.5 call 13. I collect the dividend. I sell the 39 call at a quarter, and I sell the 39 call at 24 cents. Gets called away. 5 weeks, I made $1.09. All right, tying up 39 bucks. It's a 30% annualized yield. All right. All right, now I'm in the middle of testing this, but I know I've talked about this BXY put wheel, right? The concept of the wheel can be applied to BXY and put, the put right and the BXY index. And actually, you can use this in weeklies. This is why I'm discussing this. All right. A trader can swap back and forth between put and BXY as a way to try and buy the SPX in weakness and sell it in strength. Basically, when the trader takes delivery and put, the trader might switch to BXY. We all know the difference, and I'm going to walk through what those are. All right, when a trader is called away from BXY, he or she would move back to put right, just like the wheel. So, the put, and you can do this in a weekly option on Monday that you close on Friday. So in SPX, I sell an at-the-money put on Monday. All right. SPX, I sell the put on Monday, and I could cover it on Thursday night, so that I don't have expiration. All right. And then BXY looks like this. So if I sell a put in SPX, all right, and I take deliver and I cover it on Thursday, this is the monthly. This is the monthly, but I'm going to talk about the weekly as well. All right, the monthly case is awesome. The weekly, the problem is we want to test it, but weeklies and S&P are only about 4 years old. We don't have enough data to fully get it. So this is, I do have a 26-year study on the monthlies that we're looking at. But the monthly trade, and I'll talk about the monthly as well. That's a good point. So the monthly trade is on expiration Friday, sell the first put that is out of the money. All right, then cover it, basically allow it to expire. All right, and if it expires worthless, or actually cover it for a nickel. Don't really allow it to expire worthless. All right, cover for up to a quarter. Actually, I would cover it up to $1, to be honest. But this model does not assume that. So you sell a put, and then on Friday, expiration Friday, if the S&P is down on the month, instead of selling a slightly out of the money put, you buy spiders or S&P futures, and you sell a call that is 2% out of the money. You can do this in weeklies as well. So you apply the data from put and BXY studies and convert to a wheel trade, and you begin doing the put, and then you do the put index month in and month out until the total return goes negative, and then when it goes negative, you switch to BXY, you make a lot of money. You then trade BXY until the S&P rallies more than 2%, and then you switch back to put right. Let me show you what this thing does. Unleveraged, you beat the S&P by 3.5%. And you cut the standard deviation by 1/4. All right. Now, this can be done in weeklies. Very easily. All right, you're looking for a weekly put selling strategy. It's a little capital intensive. So the way I would set this trade up in weeklies, and then we'll wrap up here. Not bad. Come on. Yeah, and then it's got quarterlies as well. Unbelievable. All right. So here's the May 1s. S&P's trading 217, right? So I would literally sell the 215 put, and I would probably, just for margin purposes, I'm paying 1/4 for this guy. So really, I'm doing a put spread. And I would be doing this Monday morning. All right, then if we get to Monday and the S&P is down, boy, those seem cheap, don't they? We get to Monday and the S&P is down, or if we get to Friday and the S&P is down below 215, on May 8th, or on that Friday morning, May 1st, I'm going to buy I'm going to buy 2 S&P futures, or you can do it in SPY, and I'm going to sell a call that's out of the money. So I'm selling like the 2060. And that's to get upside capture. Now, you're saying, Mark, why would I do SPX? That's kind of a pain. Here's where I think there's really some value in this strategy. In an IRA account, where rather than holding an S&P mutual fund, or just straight up holding spiders, no. All right, so you can. It actually just expires into cash, so it doesn't matter. All right? So here's the trade I would do. So it's SPY. I sell the just out of the money option. So I collect $1 on the 211/15. I let this thing expire. And if it expires in the money, you know what I do? I take delivery. Then I go to the May 8 contract, and I'm going to sell something that's about 1.5% out of the money. So I end up selling like the the 214 call, collecting 60 cents. And then when the S&P rallies, if it goes through 214 the following week, you know what I do? I let it get called away. And since it's a tax deferred account, I don't have a lot of the issues. This is a tough strategy for a taxable account. All right, any questions? So here is the deal. The Option Pit Starter Pack. All right, you get my silver course, which is a lot of the fundamentals. All right, access to our next Saturday class for free. The Option Pit Directional course that we did a few months back, and 1 month of Option Pit Live. In total, the value is over $700. I'm doing it for $247. Go to optionpit.com/silver special. Now, in addition, I'm going to make a very special offer on Platinum. So if you just want to get your foot in the water and see what we're like, this is a great deal. All right, this is a good deal. All right, now I'm going to give you an offer, and this offer expires tomorrow night. All right, so don't even bother emailing me on Monday. If you want to do Platinum, all right, you want to be Platinum. Well, what's Platinum? It's 9 months of Option Pit Live. It's the Gold class, and it's the Gold course, which is really a professional level educational course, and then it's 14 small group, two to 5 people, meeting with Andrew on a weekly basis, taking gold to the next level, and then it is also includes a couple of one-on-ones with me, just a couple. All right, we charge $5,000 for it. I'll do it for $4,000 between now and Friday, and when I wake up Monday morning. So if you don't, and what you need to do is email me by Monday morning, so before I wake up, and say, Mark, I want to talk to you about the Platinum deal. All right? And my email is mark@optionpit.com. All right? And I will see you. I'm looking forward to hearing from you. Now, this deal that we've got here, the silver course, the $247, that's a great offer. It's really good. So if you don't know if you're like, wow, that's $4,000, that's a lot. I mean, this is a really good package, and you should take it if you're just putting your toe in the water. And I think my clients will tell you that we do a really good job. All right. So you need step-by-step on the wheel. All right, that's fine. I will do that. Now, obviously, how do you get the free book? Email me your address. All right. Step-by-step on the wheel. All right, so here we are, May 1. Or here, we can even look at April. Let's look at last week. So here we are, Monday. And Monday morning, this is Monday afternoon. So we'll use Friday's prices. So on Friday, I go into an April 24th. Let's just say I'm just starting on this Friday. So this is Monday. We're pretending this is Monday morning. It's not exactly right, but we're pretending. So I sell, Monday I think we opened 208 and a half. So I sell a 208 and a half put at 120, 115. Then we go to the week, and on Friday, lo and behold, the market's up, and I keep the credit. Then I go to the next week, or here, I can actually go back even further. Here, we can do this. Look at this. Let me find a period where we actually do sell off. All right, so we'll start on Monday. So here we are. I'm going to the 20th, the regular March. And I sell the March $205 put at $1.90. So I'm short the 205 put at 190. I could do the 205 and a half and collect 220. So we could do that. Sell the 205 put at 220. We'll keep score on this. 205 put, 205, and I collect 220. Go to the next week. Here we are Friday. Nothing happened. I didn't take delivery. I'm now selling the 210. So I go to the March 27th, and I sell the 210 put at 90. Not a lot of premium there. Ah, crud. I took delivery. All right. Think I'm happy about taking delivery? Right now I'm not, but I do. All right, so I take delivery, and so I buy my net cost on my stock. I'm long, let's see, 207. Right now it's 310, so I'm long 206.90. Then I sell call. And I got to sell call above that 206.90 level. So I sell, you know, uh, 206.9 times 1.01. I want to sell the 208 and a half. So I sell a 208 and a half, and I collect 29 cents. You following along here? Yep. Well, lovely. Guess what? I did not get called away. So my level is now 206 and a half. But we'll keep that 206. So, and we close 206 and a half. So I'm now at the money. So 206.5 times 1.01. So I'm doing these like 1%. So I could do the 208 and a half call again, or the 209. $209 call is awesome. I'm going to get 52 cents. All right. Big day on Friday, huh? My stock gets called away. All right, so that's a full turn of the wheel. All right. So my stock gets called away at 209. So let's look at what happened here. I lost $1, right, equals, I took delivery at 210 and I got called away at 209. So I lost $1, but I made $3.89. So I made $3 trading this. Now, where does this turn into, and then I go back and start selling puts again. Now, where does this turn into a big kick in between the legs? You can see, we get a sustained drop, it has problems. That's what I said, 289. Yeah, so I made $3. All right, do we have any questions? So what did I tell you? Right around 4 hours. We weren't messing around. So let me know if you think, I really hope that you liked the course today. If you did, feel free to let me know. And if you thought it sucked, keep it to yourself. Kidding. Let me know. Seriously, if I need to do something better, I want to know. And again, email me, marketoptionpit.com, if you, or take this special offer and let me know. All right, and you're not going to get you're getting an email on this silver thing. You're not going to get an email on the platinum thing. All right, so that's really just for the people that are alive. All right, guys. Hope everybody has a great day. I'll have this up tomorrow, or by tonight.